All right, so now that we're done with the income statement, we're done with our 5-year projection of the income statement. Let's take a look now at the discounted cash flow analysis. So what is a discounted cash flow analysis? Before we get into that, let's take a step back and just go through some very, very quick basics and fundamentals of finance. What we're saying is the value of any asset is always equal to the present value of its future cash flows. Again, the value of any asset is equal to the present value of its future cash flows. So for instance, if I have let's say a conference room table, and let's say that this is, let's say if I rent this out, it will generate me $1,000 a year for the next 5 years. So therefore, if I were to discount that $1,000 a year for 5 years, and I would discount it back at whatever appropriate discount rate, how much is that conference room table is worth? Let's just say it's $4,500 in today's terms. So again, the value of that conference room table is, let's say it's $4,500. That should equal the value, the projected future cash flows that it will bring to me in the future. And of course, since a dollar today is always worth more than a dollar tomorrow, I have to discount it back. So again, how would you calculate that? Let's put in some perspective and put in some Greek alphabets here. So the value is always equal of any asset is going to equal the future cash flows, in this case, cash flow 1, then in the second year, all the way through infinity, discounted back by the appropriate discount rate, in this case, K, is the discount rate, okay? Otherwise known as taking the summation or the epsilon of every cash flow stream, discounted back by the discount rate from the first period through to infinity. That's what this formula says. So that's what the value of any asset is. Now, how do you estimate the value of this asset? Again, to reiterate this, you need the cash flow for each period. You need the life of the asset. In this case, in this example up here, this formula, it's infinity. In the example that we did with HRH, it's N. In this case, number of years, we did a 5-year projection model for HRH. And then you need to figure out what the appropriate discount rate is. Now, the appropriate discount rate is typically the weighted average cost of capital, the WACC, for a company, which is simply a blend of the required return on its stock price, on its stock, as well as its debt or whatever other sources of capital. Now, we're not going to get into weighted average cost of capital too much here, but the idea here is this. How would you do this for a company? You would say, again, you would take the discount rate and you would apply that to the future cash flow streams, and that is the value of the company you are trying to analyze. Now, if you have a cash flow that is going to grow at some implied or some assumed growth rate forever from now into infinity, what will you do? You would simply say, take this formula, which is what the long formula boils down to, and say, fine, I have one cash flow stream. It's going to grow from now to infinity at some growth rate. How much is this worth? So, for instance, the perfect example of this is the British Consul bond. So, if I gave to you $100, if I gave you $100 a year from now to infinity, and your discount rate, let's just say your discount rate, R or K, equals 10%, how much is this worth? This is equal to $1,000. And how do you get the 1,000? It's $100 divided by the discount rate of 0.1, and that will equal, again, $1,000. However, what if I told you now, I'm going to take this $100 and I'm going to grow it by 5% every single year from now to infinity? How do I now calculate the value of this? And the value of this is simply going to be $100 times 1 plus the growth rate, in this case 5%, so times 1.05 divided by the 10% minus the 5%. And that is how you calculate now the value of a growing perpetuity. In other words, this is a perpetual cash flow stream, this $100. It will grow at 5% every year. And when you take that and apply it to this formula down here, CF0, 0 stands for the latest current year, times 1 plus G divided by K, or the discount rate minus G. There are, of course, a couple of assumptions to point out here. K has to be greater than G. K cannot equal G. And G is constant forever. Now, how do you apply this basic valuation model to a company? Here's what you would do. The first things you would do is you would project the future cash flows. Well, we've done that for HRH, partially anyways. We've got the 5-year income statement projections that we already did, and we will take those numbers. We would take those numbers and we will apply it to the discounted cash flow. Then we have to discount back those future cash flows to today. That is what we would call the NPV, or the net present value of those future cash flows. But because the cash flows of this company, HRH, is not just going to die forever at the end of 5 years, we also have to assume that what this company will be worth at the end of our 5 years. And that is called the terminal value. And the terminal value simply is the value of this company at the terminal, or specifically at the end, at the terminal, at the end of our projection period. Now, again, you got your cash flows and you got your terminal value, and the sum of those two make up your discounted cash flow analysis. That's your discounted cash flow value. Now, there are two ways to determine your terminal value. The first way is the multiples method. This multiples method assumes that your business is sold, or specifically, it's valuing your business as if the company were to be sold at the end of the 5 years, or the terminal value. And how would you project that? It's simply going to be the terminal year EBITDA multiplied by your assumed terminal EBITDA. Now, how do you figure what your EBITDA multiple is? In theory, you're supposed to assume that whatever this company is worth now, how much you are buying for this company today, that is also the same EBITDA multiple you use to value it in the terminal year. So, what that means is you're not assuming any multiple expansion, you're not assuming any multiple contraction. You're using the same base case. Now, the second method of projecting or estimating the terminal value is to use the perpetuity growth, which we already talked about that in the previous slide. What this is this assumes that your last year's cash flows are going to grow at some growth rate from now to infinity, or specifically from the terminal year through to infinity. And therefore, you will apply that growing perpetuity formula, also pioneered by Mr. Gordon, the Gordon growth rate model. You will use that formula. What was the formula again? It was CF times 1 plus G divided by R minus G. You will apply that formula to your last year's free cash flow estimate. So in other words, that free cash flow number, this cash flow number here, that is going to be what? That will be your last year, your terminal year's free cash flow number. And then you would grow that by G, which is your assumption of what it will grow by. Now, you would then divide that whole stream by R minus G, which again, R will be your WACC, will be your weighted average cost of capital, and then minus the same G. Now, that's summarized by this formula down here. Terminal value equals terminal year's free cash flow estimate times 1 plus G divided by WACC minus G. Now, with that in mind, here's a question for you. What is an appropriate value for G, the growth rate? We always like to say, you look at a company that's growing at 15%, looks pretty good, 10% pretty good. But once you're starting to get to single digits, maybe 5%, you look at yourself and you say, hey, listen, this is a slow growth company. So with that in mind, is a G growth rate of 5%, is that reasonable? Is that reasonable? Is that too high? Is that too low? People would like to look at companies that are significantly growing faster than 5%. So is it fair for us to use a 5% estimate? Well, I'll tell you my answer to that. The answer would be that would be unreasonably too high. Why would 5% be too high? Well, think about it this way. What is the long run, the super long-term, long-run growth rate of the U.S. GDP or the world GDP, the entire world economy? It's not 5%. It's something more like around 2 to 3%. So if you were to project that your company were to grow at 5% every year, whereas the GDP of the world or your local economy is growing at 2 to 3%, at some point in the very far future, but at some point, you will be greater than the world economy. And therefore, 5% growth is normally too high. So what would be a more of an appropriate growth rate? Anywhere between 0, 1, 2, maybe 3%, maybe 4%. So with that in mind, let's now take this information